Let's think of it as a stone thrown in the pond and the ripples that are kind of expanding beyond it. The first ripple, as everyone's been talking about, is Comcast and Fox and Disney. That is a when, not if, and the only question now is, does the bid come tomorrow, or for some reason does it wait until Thursday? But that bidding war is a virtual certainty. Beyond that, though, if you take a step back and you think what's happening in the media ecosystem more broadly, what's happening here is that, notwithstanding Randall Stephenson's promises that we would not withhold content, you're actually seeing the whole content world consolidating around a closed vertical system where Netflix produces its own content for its own customers, where Disney is talking about going direct to consumer, its own content for its own customers. Comcast is bidding for the right to produce its own content for its own customers. All of those systems are going to have to be very, very large. And so the bigger question here to me is not just kind of the short-term dominoes of who might get acquired, but it's stepping back and saying you're seeing the entire concept of the media ecosystem being rewritten from open systems to closed systems. And those systems, almost by definition, carry huge amounts of risk. It is a much, much riskier business proposition going forward than it has been in the past. It used to be a studio would have a bad year, and they were selling their content to all the different distributors. They had output deals that got them through fallow years. You had different distributors taking their content from every studio. All that collapses down to these kind of vertical pipes of one-to-one, and suddenly the risk in these individual systems gets to be very high.
So does that mean historical valuations are out the window, Craig? I mean, that we should be valuing these companies because there's this embedded risk in a much different way than what we've been doing in the past?
I think that's absolutely inevitable. And let me ask an interesting rhetorical question for a second, because this is what Comcast is trying to do, right? Comcast is trying to say, let's go off and buy Sky, get the distribution scale that we want with a bunch of exclusive content licenses that we know, frankly, are going to go away over the next few years. And so we're going to pivot just like Netflix pivoted, and we're going to move from licensed content to producing our own content, hopefully with the backstop of adding this Fox studio to help add heft to that studio production machine, right? Let's suppose they win and succeed, and that model starts to work just like Netflix, which is to say it creates a very large pool of customers that lose a lot of money. Would Comcast actually get a valuation anything like Netflix for a large pool of customers that loses money? I'm not sure. And so even what winning looks like is not entirely clear.
Well, Craig, let's talk about winning real quick, because the market, the participants of the market, these two companies specifically, have bid Fox up now to close to 19 times next year's earnings, which is almost twice some of its rivals. Now, I get it that it's valuable, but is it that valuable? And should the rest of the space get dragged up? Or are these guys going to bid it up to such where they're going to win, and then they're going to look around saying, what did we just do for $85, $90 billion?
Well, I think what's unique to Fox, my partner Michael Nathanson has been telling our clients that the opportunity in Fox is that the amount of leverage on the Fox stub that remains suggests that the stock price is actually a coiled spring. And so he's been extremely excited in recommending Fox in advance of this set of events, because there's so much potential there for even relatively modest increases in the bidding for the collective assets. But more broadly, does it mean that valuations are going to go up? Sure. There is almost certainly going to be another wave of M&A. I'll play the role of the ant at the picnic for a second and just pour a little cold water on the idea that all this is actually some kind of endgame nirvana, right? The real challenge here, let's go back to the real world for a company like AT&T for a second. Time Warner, AT&T is so large that Time Warner will only amount to 15 to 20% of Time Warner's revenue, or of AT&T's revenues after this deal. And the rest of AT&T, the other 85% of AT&T, is shrinking in every business. It's shrinking in wireless at about 1.5%. It's shrinking in the wireline enterprise business that, by the way, is as large as the entire company of Time Warner. That's shrinking at 3.3. It's shrinking at DirecTV at 3.5. And every one of those businesses is seeing margins fall even faster. So DirecTV and the entertainment group is seeing EBITDA fall 19% right now. Wireless is falling 5.5%. Time Warner is not big enough to change the trajectory of overall
AT&T. So this is just a
AT&T.
temporary lifeline for AT&T.
It helps fund the dividend for a little bit longer,
Right.
but be careful what you wish for, because you're taking on an awful lot of debt in order to do it, and it makes AT&T a riskier proposition as well.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.